Hi everyone, Joe Lopresti here with our latest proactive asset allocation strategy update for Friday, April 21st. Our last update we sent out in written format and reported to you that we did see some good improvement in our core indicators. That was coming off of the weak market in February and the first half or so of March. Many of our indicators improved coming off of that bottom. We did get close to a sell signal in our model when the market was stumbling, but it avoided a sell signal. And we thought that that improvement in the core indicators was worthy of reporting to you. In that written update, we also pointed out that we saw 3 hurdles for the market to continue to see progress moving forward. And in this week's video, we want to update you on those hurdles. The first was that markets were beginning to approach a resistance level. There's a pretty clear level in the major market indices. In particular, today we're going to look at the MSCI All Country World Index, and we're going to see right around the 660 level a few times in the last, say, 9 months or so. The market approached this level, but was always rejected at that level, and stocks dropped off of that 660 level. We'll see if we're making any progress in breaking through that resistance level. The second area that we wanted to see was, while we did see some early improvement in our core indicators coming off of the March bottom, we wanted to see further improvement. We want to see the cash comparison chart and long-term momentum indicators continue to follow through in their improvement. And importantly, we wanted to see breadth expand, because a lot of the rally in, say, late March, early April was really due to just a few handful of mega cap stocks, the ones that really drive the S&P, for example. So the market breadth was very narrow in that early stage of the advance. And really, for a healthy market movement, we want to see that breadth expand out into more stocks, more sectors, and more asset classes. So we'll update you on that regard as well. And then the final hurdle, as has been a bit of a thorn in our side now for several months, has been our recession models. Our recession warning models continued to point towards a recession. That creates headwinds for stocks. So we'll give you some update on our economic modeling as well today. So let's jump right into looking at a chart of the MSCI All Country World Index. And you could see, if we put a line right at this level here, right around that 660 level, the market came up to it going back to last May. It did it again in September of 2022. In February, just before the banking crisis driven correction, and now we're back at that level. That's a resistance level, and we could see even in the last few days, as we've started to approach that 660 level, stocks have kind of stalled out and are meandering a little bit in the last handful of trading days. Well, obviously, to make any significant progress moving forward from this point, we need to break that resistance level. So I think next week is going to be an important week. We're going to get a lot of the big company earnings out. Apple, Microsoft, Amazon, Google, some of the big boys are going to be reporting. And that could either turn the market down from this resistance level or finally break through that resistance level. We're not going to take a guess at which way it's going to go, but we would say that breaking through that resistance level would be a really good setup for the market, because what we see here at the bottom is a pretty nice rounded formation, which technically is a good bottoming pattern if we could break through this resistance level. You could also see this white line, which is a 210-day average. Every other time we came up to that 660 level, the 210-day average was dropping. Now it's starting to slope upwards. So we'll see if that could break through and continue that momentum to the upside, or if it's going to be rejected once again at the 660 level. The second hurdle was we wanted to see continued improvement in our core indicators and indicators overall. And we could see that from our PAS dashboard. The cash comparison chart, which was negative for a short while when the market was correcting, has moved back to neutral. We'd like to see that continue to improve and, of course, eventually move back to positive status. That hasn't happened yet. The long-term momentum indicator, which dipped to neutral during the correction, has moved back to positive status. So that is a good sign. We're going to take a look at the long-term momentum indicator. But now we want to see it continue to follow through. Some of these movements are just minor and flipping the signals, technically to neutral or positive. We want to see meaningful progress in some of these indicators. And we also pointed out in that written report that we wanted to see the breadth of the market expand. And we'll see that with our universe trend indicator, which has been neutral during the correction, has not improved back to positive. And to us, that's a bit of a negative. We want to see that improvement. We don't want to see the market moving with just a narrow group of stocks, kind of the generals leading the charge as opposed to the troops leading the charge. So let's start a review of our indicators by looking at the universe trend indicator. So here is the universe trend indicator, the UTI as we call it. And what we could see is that the traditional scale chart did reverse down in March when the market was correcting. So it hit its high in February at 52% and dropped down to 44%. Right now we're sitting at about 46%. So a little bit of improvement, but really not that much improvement. With the market challenging that February high, we'd really like to see this percentage challenge its February high too. That hasn't happened so far. So we're seeing that breadth continue to lag the market in the last couple of weeks. And over on the logarithmic scale chart, it did not reverse down during the March correction, but it did get up to 58%, and now it's sitting just a bit below that at 56%. So collectively, we'd like to see both of these indicators take out that February high. It would be great to see 60% on this chart and at least a reversal up on the traditional chart, and ideally moving above the 52% level that we saw in February. That would be indicative of a market that is seeing more participation in the trend up, as opposed to limited participation, which internally indicates a bit of a weak market environment. Let's move over to our long-term momentum indicator, and we could see at the end of March, it did have a positive reading again. So, we did get a pullback in February, and it turned to neutral as indicated by that white shading in the background there. The rally towards the end of March brought it back to positive. But really, these are more technical changes of status. We want to see meaningful movements in the market to indicate that momentum is really beginning to lift off. And you can see here, while it is sloping upward, it's not doing it in an aggressive way. And we'd like to see that eventually happen. Something like this nature coming off of the 2016 bottom, or of course coming off of the COVID bottom. If we expand this out and get more history, we're looking at the last 10 years right now. And this brings us all the way back to the inception of this indicator, which goes back to 1995. Again, you could see when we start to see that aggressive move up from a bottom, it indicates that stocks are strong and a meaningful up leg is beginning. So we're not quite there yet. We'll see if over the next few months we do get to that point. The final hurdle to getting to more of an ongoing bull cycle is the economy. Our recession warning models continue to warn of a coming recession. The message here has been pretty consistent for the last 7 months or so. And while we don't have the March numbers in yet, we still have February, all the data for February in. What we do have in for March, it really isn't showing that we're going to see anything significant on the side of improvement with the economy. In fact, more than likely, we're going to continue to see deterioration in the economic numbers coming out. In fact, one of the specific economic data points that we look at many, but one is housing starts. Housing starts is now updated through the end of March. And what we found by looking back in the past, what's a good leading indication for a coming recession is when the 1-year moving average of housing starts drops below the 2.5-year. Okay, so you see that here in 2008, actually happened in 2006, well before the '08 recession. You see it happening going into the 2001 recession and the 1990 recession and so on. Well, we now have really, I think for the last 3 months, I believe, the 1-year moving average has dipped below the 2.5-year moving average. So we have that crossover. Another way of looking at that is on this chart, which just shows the zero line. When we're below zero, the 1 year is below the 2.5, and when we're above zero, you can see the extent of the differential. So we're clearly dropping. This does look indicative of other times when we've had big drops and quick drops in the housing starts number. And with housing being such a big part of the economy, when it deteriorates, usually it spreads into other sectors of the economy. Here's our weekly leading economic index. This is updated through the end of February, and you could see still below zero, although a little bit of improvement, but the important point is below zero. We really can't get excited on improvement until we could get back above the zero line. Again, drops below zero tend to correlate with future recessions. And then our monthly leading index. And here we have two lines. The blue is a long leading index. The red is a leading index, just by not as far in terms of prediction future recessions. And you can see both are negative. And the long leading hasn't been this negative for 40 years, going back into the 1980s. It's hard to envision the economy escaping a recession with all of these indications that have historically been a good, accurate prediction of coming recessions. Hard to expect us to be able to escape a recession this time around. So the question is when the recession will come. The further into the future it comes, the more runway there is for stocks to continue to potentially move higher for a period of time. We've talked in the past how we're still in that seasonally strong period for another 6 months or so. So it's possible that stocks will continue to chug higher if the recession is put off, say into 2024, for example. However, if that recession is beginning now or in the next, say, 3 or 4 months, it's going to be hard for the stock market to continue to make further progress through the spring and summer period. So as you can see, improvement happened off of the March bottom, but we haven't seen a whole lot of follow through to that. The breadth still looks pretty weak to us. That resistance level is still straight ahead, and unless the market can take those things out, I don't think we're going to get a big move up in stock prices. And it certainly is possible that that will materialize and can happen. But those are some of the obstacles that we see ahead for the stock market. Of course, the economy's there. That's just a matter of timing of when the recession happens. So you can see there's some conflicting indications. The recession model is clearly pointing down. Our market model has been positive now for the last several months. So we continue to be invested partially with a growth focus, partially in a defensive posture with investments in defensive types of assets. Well, that's going to wrap up this update. Thanks for watching and enjoy your weekend.